Hello guys and welcome back to my YouTube channel. I am Muhammad Abdullahi aka Speedo aka Mai Nasara. Mai Nasara means the successful one, and I wish everyone watching this video is going to be successful, inshallah. If you stick around to this YouTube channel, you are not going to be entertained only, but you are going to learn a lot of valuable things and a lot of secrets from my 8 years of trading experience. And I'm pretty sure you are going to be a whole different trader. So in today's lecture, I want to show you guys one of the secrets to trading profits. And this secret, I have actually like started implementing it after, hearing about it one more time from one of the top profit traders I respected in this space. It is a method that I have been using for a very long period of time, but I have never tried it in prop firms. But when I listen to that trader, I am going to reveal the trader before the end of this video. When I listen to the trader, and this trader single-handedly made uh, $2.5 million in one single pair. So it is the type of people, he's among the type of people that I look up to, you understand? So, and since he did something that I wanted to do. So I have to listen to him and I have to, copy from his system and implement it in my system. And it was so amazing when I started implementing that. It made a whole lot of sense and it changes the way I trade prop firm. So if you trade prop firm, this secret is going to help you in as much as you implement it correctly. And this secret, I also heard about it from one of the renowned traders we have, that is Jesse Livermore. He spoke about it. And also Tom Hogarth, one of the greatest trading psychologists, he is still alive. He taught this process in one of his books, that is Best Losers Win. This process is none other than this, okay? Is knowing, when to add to a winner for a maximum profit. Some may call it layering, and some may call it scaling. It it just doesn't matter how on what you call it, okay? So now this approach is an approach that go hand in hand with risk management. Jesse Livermore, I quoted him once saying, the best traders are those who already, accepted the uncertainty of every single trade they are to take. But one thing they have that distinguish them from unprofitable traders is this. A profitable trader, before entering a trade, already defined risks. But that is not all. You have been hearing about risks from everyone. But that is not all. Defining the risks is entirely different from how the approach you use in taking that risk. Let's say you are trading $100,000 account based on what Jesse Livermore thought. Out of this $100 account, the industry says for you to remain consistent, you should risk at least 10%. But Jesse Livermore approach is entirely different from this. He says you shouldn't risk more than 1 to 2% of your account, because it's just like an army, soldiers going into battle. You need to be very careful and strategic on how to fight that battle. If care is not taken, you will be fighting an enemy that is having less soldiers than you. If the enemy is more strategic, that enemy will defeat you. So numbers is not what, in a nutshell, the interpretation of this is, let's say you have $100,000. $100,000 is significant amount of money. You understand? And let's say you are risking 10%. Somebody that is just risking 10% has only 10 shots. And in trading is such an environment whereby at times you may find yourself in a losing streak. And we have different trading strategies and trading approaches. Some trading strategies may have 4 losing streak average, 5 losing streak, 6 losing streak, 3 losing streak. Like, for instance, like my own trading approach, I may have up to 4 losing streak in a row. That is what my data has shown me, and that is what I have been trading with. And I accepted it because when I backtested this strategy right before I become profitable, it has shown me that it has up to 4 average losing streak. And as I have been trading this strategy for the past 4 years, at times I may pace up to 4 losing streak in a row. So also it has winning streak. It has up to 5 winning streak in a row. So now let's say you have 100K account and all you do is risk 10%. You have only 10 trades left. The thing is, even if your strategy is having 5 losing streak in a row, you may find yourself maybe in that losing streak period whereby you are down with minus 50% of your starting capital. The problem is not in having that 5% losing streak and having find yourself on minus 50% drawdown. The problem is the psychological trauma it comes with. Only few array among the traders can be able to handle that pressure and that, loss. A lot of traders will not even tolerate 40% drawdown. They will start, losing themselves to emotions. They will start over trading. They will start, panicking. They will start losing confidence. A lot of things will happen, which might lead to them blowing that account. So what Jesse Livermore thought is, for you to stay long on enough in this game, your main goal is not to make huge amount of money at once. Your main goal is to survive. And for you to survive this market, you should be risking at least 1 to 2% per trade. If you are risking 1%, you will need hundreds of trades to blow your account, which has never happened to any trader before. There is no way you can take up to 100 trades and you all lose all those 100 trades. It is going to be impossible, except if you are trading with complete emotion. I never see a trader, I never heard of a trader that took up to 100 trades in a row and loses all those trades. So now, realistically speaking, if you are trading 1 to 2%, you are going to survive in this market for long. And survival is the number one priority of every trader. You build wealth through compounding. You build wealth over time. You do not just build wealth risking a lot. Now, take for instance, somebody that is risking 10%. This particular person can have 2 good trades and can make 50%, 30% of their account. What about if this person is facing losses? 4 good trades, 5 good trades, 5 bad trades, or 4 bad trades, this trader is going to be down with minus 50% of his initial capital, and this trader is going to lose it to the market, to the emotions. So that is why to survive in this market, you need to have a very sound risk management. And based on the teaching of Jesse Livermore, you need to stick to 1 to 2. And since we are talking about prop firm, now if you are trading with a 100K prop firm account, let's say you are trading with a 100K prop firm account, how much is your max drawdown? Your max drawdown is actually 10,000, which is just 10%. Now, let's say you get funded with this amount of money. Do you think it is okay for you to be risking 2% on $10,000 account? Well, let's take the math. If you are risking 2%, if you find percent in 5 losing streak, your account is gone. How about if you are risking 1% and you find yourself in 5 losing streak? That means you'll be down with minus 5%. Will you be, emotionally be able to handle when you find your account on minus 5% drawdown? Now, how about you are risking 5%, 0.5% in a trade, and you find yourself in 5 losing streak? You will just be down with minus 2.5% drawdown. So you see, the bigger risks you take while trading, the more you engage emotion and the more you attract distractions to your account. The smaller risks you take, the more peaceful you become. When you take smaller risks, it helps you not only to survive in this market, but it helps you and it saves you from a lot of stress. You will not take a trade and be worried too much and be too concerned about the outcome of that trade because you risk something that is very realistically small. And you are not aiming to be rich and wealthy in that particular trade. So you risk something small that will allow you to go and sleep without having, without disturbing your sleep. You can sleep peacefully with impunity. So the smaller you risk, the better, especially when you are trading with prop firms. But since I laid this explanation in this foundation, let me explain something. You can be risking very little and be making a lot, like what you have seen me did with on the previous lecture while I was trading the pursuit drawdown. And that is what they call went to a winner, layering or scaling. Now, this is the approach. Let's say you are risking only 1% of your account. And let's say you have a setup. This is your initial setup and you have gotten an entry. As you have this entry, let's say you just risk 1% of your account on this entry. Then you risk 1% of your account. Then the market start moving on your favor. And as the market is moving in your favor, this is where the twist comes in. A lot of traders will be fearful as the market is moving on their favor, especially unprofitable traders, because they will be thinking market has given them money and any retracement is going to make them panic that what if the market come back and take away that money it gave them and remove them. So you see an unprofitable trader entering a trade, and the moment the market start moving, that trader will be panic, and a small retracement will make that trader exit at small profit. In a nutshell, unprofitable traders become hopeless. They become fearful when the market is moving in their favor. But what does the profitable traders do? Profitable traders are looking for opportunity where the market is favoring them, and then they look for another opportunity to add more position on that running position. So this is where the belief is switched. Unprofitable traders become fearful, they become scared when market is moving on their favor. Profitable traders become hopeful when the market is moving on their favor. So if the market retraces, instead of the profitable trader to exit, the profitable trader will be looking for a second opportunity to add another position while protecting their first position. Let's say this is the target, and let's say initially the trader is targeting 4R. Let's say this is the 4R, and this is the initial position. So when you take your initial position here, let's say your stop loss is around this low, and you are targeting for that high. As the market started moving, then you have retracement. Not every type of retracement and not every random point you are going to take another entry. You are going to take entry based on the strategy and the concept you are trading and based on your system. Like my system, let's say I take an entry after seeing breakup structure and within a fair value gap, and I have retracement within a fair value gap within the kill zone. And let's say that is the criteria for me to take another entry, then I take it. I'm not just going to take random entry because a high is broken or a low is broken. Then what the profitable trader will do is they will enter the first position risking only 1% here, and their stop loss is going to be here. Their stop loss is going to be here. Okay. So their stop loss is placed here. And as the market was moving in their favor, they returned back the stop loss to break even, making it risk-free trade. The first trade is now risk-free. Then as the market retraces to give another opportunity, they add another position and their stop loss is going to be below and they risk another 1%. So you see, initially they are aiming for 4R on this trade, and now they have another setup. That means they will get 4% on the first trade, and on the second trade, they are more likely to get 3% or 4% again. One particular trading idea, but because of the ability to flip the switch to be hopeful when market was moving on their favor, they were able to add another position, making the first position risk-free, and then when the market hit profit, they will now be sitting around 2 times the initial profit target they have. So this is what the 10% profitable traders are doing that is separating them from the 90% unprofitable traders. And you must learn to do this, especially when you are trading with prop firms. Now, you see, you are not risking a lot. You are not risking much. You are risking initially what you wanted to risk, and you are making a lot. I know the pay, and the question is, what if the market reverses back and it's come and take me out? If the market reverses back, it means your first trade, you risk nothing because you already returned this stop loss back to break even. And your second trade, you now have minus 1% loss. So you see, you didn't take any loss. And there is no guarantee whatever type of trade you enter, it may come back and hit your stop loss. But what is guaranteed is, in as much as you are following the process, you may not hit take profit on this trade, but you may hit take profit on other subsequent trade to comes. That is the reality of trading. So you must learn to add to your winner for you to maximize profit while risking very, very little. And for my suggestion, when you are trading with prop firm, you should know the type of risks that is practically and realistically solid to help you pass a challenge and to help you maintain a prop firm on that account. So now let's go into the chart and let me show you an example, okay? This is an example of a trade. And when we come to 4-hour time frame, you see this key level. We have this 4-hour fair value gap, right? And I call it A plus CQ, A plus constant trend qualification. This is one of my key secret to trading ICT concept. I discovered this constant trend qualification myself. So after this market rejected on this 4-hour key level, our target is to see the market continue to go off, approach the all-time high, take these highs and continue buying. And we can see the market is now currently going up. So here's the deal. As the market reacted on this 4-hour fair value gap, we go down to smaller time frame to start looking for confluence to take the trade. And here is a confluence. You can see we have this order block. We make use of these 3 candles as one order block. We have this order block, and this is that 4-hour rejection. And as price tap into this order block, taking this sell side liquidity, you can see we have structure, swing low, high, low, and we have this displacement, break up market structure. Okay, as we have this break up market structure, let's say you take an entry here and you are aiming for 4R or 3R, depending on what your target is. Let's say you take an entry here and you are aiming for 4R or 3R. Let's say you are aiming for 3R. This is your 3R. So you see, market mitigated your POI. It started moving. As the market started moving, the question you have now in mind, I know, is where and when do you add another position? You add another position when the market met the criteria of your model, of your system. You see, someone will add position here. I will not add position here. Even though this is a retracement, we have market pushing up, coming back, pushing up, breaking these highs, coming back to this fair value gap. I will not add position here because for me, it is outside my system. It happens around 6:15 London launch. I do not take trades during London launch. So I will continue holding this trade. My stop loss is going to be here. And you see, we have this low and we have this high formed and we have this huge retracement. Where does this market retrace back into? It retrace back into this fair value gap. So market retrace back into this fair value gap. And this is this type of retracement that fits in the system I trade for me to take another fresh trade. So if I risk 1% here, now I will move my stop loss from this level. If this is my stop loss, I will move it back to break even because this is the perfect time for me to add another position. And then I will take another new position here. I will take another new position here, targeting for at least 3R. So you see, one trade idea, trade number one is now risk-free. One trade idea, two opportunities to double in your profit. First target, you target 3R. Second target, you target 3R, making it 6R in total, risking only 1%. So this is the approach I have always used. You call it whatever you want to call it, but this is the approach I have always used in when I'm trading a Profim challenge account. That is why sometimes I am able to pass a challenge in one trade or two trades. And boom, this is a challenge you should also study, practice, backtest it, and try implementing when trading Profim. And it is going to make a huge difference in how you approach things. I learned this approach. Credit goes to JetCav ICT. JetCav, one of the chartered ICT student. He has been trading, I think, for 15 or 16 years. I learned this approach some couple of years back when I came across him, how he's performing with Profims, and he's doing amazingly well with this approach. So if this is the approach that you think can help you, go and backtest it first. You not just implement it, backtest it and collect data with it and see magic in your trading career. Make sure you subscribe, like, comment, and we meet in the next video.